David, why are contrarian strategies the best way to invest?
Well, Lindsay, they've worked very, very well over time. There are studies that go back even to the 1930s that show that if you bought the out-of-favor stocks by various contrarian strategies like low price earnings ratio, low price to book, low price to cash flow, and even higher yield, you'd outperform the market.
Would you say that psychology trumps multiples and valuations and other quantitative measures of stocks?
At times, yes. And we're probably in a period where it does, because we're seeing we're at some of the lowest price earnings ratios in 20 years, and because of the European crisis, and it's probably we're probably overreacting, I think, and so psychology is very, very major in this. When people are worried, as they are today, they get out of stocks at very low prices, and the volatility, of course, helps that, helps them or hurts them in the fact that they're really selling stocks far too cheaply. These companies a lot of the American companies have got very strong fundamentals, better cash than they've had in a couple of decades, and earnings are going up.
What are some stocks right now that investors can take advantage of because they're suffering from that market overreaction?
Well, I think if I were to look at Europe, I'd look at some of the major companies, Philips, say Unilever, all of which have been slammed lately.
Right.
And these companies are going to make money over time. Unilever's got, I think, a 50% or higher percentage of its business outside of Europe. Mm-hmm. And they will continue to make money, and yet they're very much in the doldrums. The European markets have done much worse than the S&P, and I think there's some good opportunities there. In the U.S., I think there's major opportunities in some of the exploration and development companies in oil and even, to a lesser extent, natural gas.
How do individual investors compete with high-frequency traders and hedge funds?
Well, the HFT is a high-frequency trading. It's a new phenomenon. High-frequency trading is something like 65% of all the trading, 65% of all the trading on the New York Stock Exchange. In a period of panic, they don't create the panic, but they jump in. If the market's going down, say the Dow's down 100 on bad news in Europe, or 150, they'll short, and they'll have what they call quote stuffing, where they not only do they short, but they work so fast that they'll put an offer to sell, say, hundreds of millions of dollars for 4/1000th of a second, and then another one will come in and offer it for 4/1000th of a second. And if you're a trader on the floor and you see this overhang, or you think this supposed overhang, you're going to want to get out of Dodge City fast.
Yeah.
And so I think they're a very negative influence on the markets.
Okay.
And I think they're responsible for a lot of the volatility.